is one of those rare financial wizards who has served as policymaker and regulator in several countries, including China, Hong Kong and Malaysia. A Chinese Malaysian by birth, he was assistant governor at the Malaysian Central Bank in the 80s. In the 90s, he served the Hong Kong government as head of the Reserves Management and then chairman of the Securities and Futures Commission in Hong Kong. Currently, he is chief advisor to the China Banking Regulatory Commission. Also, he is board member of the Qatar Financial Center Regulatory Authority. From the rise of Malaysia as an economic power to making policy in Hong Kong during the Asian crisis to helping China develop a modern banking system, there's hardly a problem in the financial sector which Dr. Sheng hasn't handled. Dr. Sheng, thank you very much for joining us.
My pleasure.
Well, Dr. Sheng, how would you look at the European situation at this point in time? Clearly, there are policy struggles between the supranational forces and the national forces. How might Europe end? More integration or one or two countries walking out?
The first thing you remember about crisis is that it's very difficult to predict the trigger and almost impossible to predict what will develop. But I think, and Europe is going exactly through that phase at the moment. It's a crisis has very many different origins. Then you have to go in to do some damage control. And Europe is exactly in the second part, which is still evolving, that of loss allocation. Who is going to pay for the losses of, all the sovereign debt crisis and also the banking problems? The structural issue of the integration is necessary in the sense that you can have a central bank, you can have one currency, but if you don't have a centralized Ministry of Finance or fiscal mechanism to how shall I say, distribute the gains and losses of a fixed exchange rate system for the whole region, then problems will occur, and that's exactly where things are going. So I think there are three scenarios, I was told, and I believe that is the right case. One is a muddling through scenario, which seems to be what is happening to some extent, that you solve it this week and next week the things seems to unravel, and then you have to solve it again. The second one is further integration, and then the third one is whether you bring in an outsider like the IMF to help you resolve this problem.
But your short answer would be that Europe may lean on the side of allowing a little bit of its sovereignty to be sacrificed to a central authority. That's the more likely outcome. My own thinking is that the Eurozone will survive. It doesn't mean that there may not be one or two casualties. But I think everybody recognizes that the cost of joining a Eurozone can be expensive, but its unraveling could be even more expensive for everybody. So with that understanding, I think there is now increasingly political awareness that some kind of concession of national sovereignty towards a more central fiscal mechanism is necessary. All right, let me come to the other issue that bedevils and bothers us in India. The rapidity with which the US dollar depreciated against many currencies. That depreciation has kind of plateaued a bit only because Eurozone went into problems. So vis-a-vis the euro, the dollar couldn't weaken beyond a point. But what is the sense you're getting from here on? Does the dollar continue with its depreciation because of its inherent instability? Will that be one of the big themes of 2012? Will it revisit as a big theme the weakening of the dollar and hence more expensive commodities?
My own position is that actually don't expect any major currency to go one way. I personally think that the U.S. economy is much stronger than most people think. As you know, I'm a great believer in the real economy. If you really look at the United States, it is very strong militarily. Its corporate sector, in fact, is extremely strong. They have very strong balance sheet. They're totally global. The most successful ones are totally global. They don't borrow too much. And their corporate governance, compared with their competitors in Europe or in Asia or anywhere, is much stronger. So, my fundamental belief is that the U.S. May be going through a difficult patch. The difficulty at this point of time is somewhat similar to that in Europe, and that is the very large fiscal overhang. But if there is bipartisan recognition that something needs to be done, and that is stabilized, actually there's no reason why the U.S. economy cannot continue to grow. And of course, everything is relative. Will the growth be as strong as in the first decade of the 21st century? Probably not. There will be some slowing down because the other sectors, such as finance, government, and the household sector, will need to deleverage. Now, that doesn't mean that there are some further risks. We all hope that the property market will not continue to tank, and we all hope that the unemployment numbers will not continue to increase. But my basic scenario is that relative to the others, the U.S. economy is doing much better than many outsiders would claim. Now, how does that compare with the emerging markets? I personally think that because the United States dollar is the global reserve currency, its role will not change very drastically. Now, and we have seen this. Whenever there's some problems with the euro, the yen, or the emerging market currencies, there's a flight back to the dollar.
Yes.
So I would caution people not to say that, well, there's only one direction it will go.
Well, Dr. Sheng, we have to take a break on that note, but we are coming back with a lot of questions now. We would expect you to wear your market regulator hat and give us your comments on several issues that face Indian capital markets. We're back in a minute with more questions for Dr. Sheng.